Hello students, welcome to Financial Economics. My name is Nan Zhou, and I'm going to be your instructor for this class. So before we get started, I just want to spend a little bit of time talking about what this class is going to be about and some of the topics that we're going to be covering this semester. Right off the bat, we need to say that what this class will not be about is that we're not going to teach you how to trade and how to make money in finance. I get that this is what a lot of students want to get out of finance courses, but for one thing, there really aren't any secrets that will teach you how to make money in finance. It doesn't really work like that. And if anybody out there is claiming that they can teach you these kind of secrets, they're probably lying to you. And of course, if we had this information, if I had some secret information about how to make money trading stocks, I wouldn't be telling other people, right? I would be using it and profiting from it myself. So get it out of your mind now that this is not really what the class is going to be about, right? The class is not really going to be about teaching you how to make money. What we're really trying to talk about is kind of the principles and the foundational concepts that make up financial economics. And so what are those? Well, the main focus of this course is going to be on asset pricing. So where does the value of financial assets come from? And specifically, we want to focus on the relationship between risk and return. We're also going to be touching on some corporate finance topics, talking about project evaluation and capital structure, so investigating firms' investment and financing decisions. And finally, we're also going to spend a little bit of time talking about market microstructure. So that's a structure of financial markets and exchanges and how information and liquidity play a role in financial markets. So to get started, the most basic question we might want to ask is, well, what is the financial economy? What is the role of the financial sector? And specifically, how does that contrast with the real economy? So we want to think about the real economy as being the economy that produces tangible goods and services, right? So in contrast to this, the financial economy doesn't produce tangible goods and services, and the value of financial services is a little bit less obvious, right? When we're thinking about, well, what value do banks and hedge funds and insurance companies provide to society? Well, that's a somewhat difficult question to answer, right? And the way I want you guys to think about it is that the financial economy really exists to be a facilitator. The financial services serve to channel funds from people who have resources to projects where they can be used to generate value. So the financial economy, you can think about, enables real economic activity. And when we're talking about financial assets, like stocks and bonds and derivatives and so on, well, unlike real assets, financial assets don't have any intrinsic value. Holding a stock is not going to make you happy in and of itself, right? There's no value to holding a stock just to have it. Financial assets instead derive their value from having a claim on some stream of cash flows. So this is something that we're going to be focusing a lot in this class, talking about asset pricing, that when we think about a financial asset, we don't want to think about what it really is. All we really care about is, well, what cash flows does this asset promise me? And how much are those cash flows worth to me? So if you want to think about the purpose of the financial sector, well, on one hand, we have firms that need resources in order to undertake projects that are going to generate economic value. So firms need resources in order to be able to operate, in order to be able to do stuff. On the other hand, you have investors who have resources and they want to invest them in a way that's going to generate the best return. And so, before the development of what we think about as the financial sector, there were still ways to facilitate this type of activity, right? You had kind of informal financing networks, so familiar networks and other types of communal networks where, people could borrow and lend from each other. And while this worked to an extent, you can kind of see the flaws in it because, in some sense, imagine if you were an investor and you had some capital that you wanted to invest. Well, what are the chances that the best investment opportunities you could find were within your immediate circle? By the same token, if you had a really brilliant idea and you needed to raise money in order to carry out this idea, well, what are the chances that within your immediate social networks that you had enough resources to be able to carry that out? So the development of a formal financial sector allowed a lot more of these types of connections to be made, and therefore facilitated a lot more economic activity than would have been possible without it. So you can think about this is the true role of the financial sector, right? To facilitate activity, to connect investors with firms in a way that would not be possible without it. So we want to think about what types of financial institutions are out there. And when we're thinking about financial institutions, all of them fundamentally play the same role. They're going to serve as intermediaries to channel funds from investors to places where they can be used to generate value. So you're channeling funds from investors to productive activities. So we're all familiar with commercial banks. Commercial banks are going to take deposits and then they turn around and lend that money out, whether to individual borrowers or to firms. We also have investment banks. Now, investment banks don't take deposits in the same way that a commercial bank would, but fundamentally, they fill the same role. Because rather than taking deposits and lending that money out, what they're going to do is they're going to underwrite issues of debt and equity securities. So a firm may want to borrow money, they may go to an investment bank. The investment bank will then market the bonds to potential investors. Now, this is not the only thing that investment banks do, and this can create a little bit of controversy because there's a lot of conflicts of interest that might arise. So that's one side. We can also think about the other side, consisting of institutional investors like pension funds and mutual funds. And these are going to be financial institutions that are going to invest on behalf of their clients. And the advantage of institutional investors is that by pooling a bunch of money together, they can take advantage of economies of scale. So a mutual fund will typically be able to trade with much lower costs than an individual would proportionally. Finally, we can think about the role of insurance companies, and this is going to be something that we're going to be discussing a lot in this class, which is risk management. Now, how do insurance companies manage risk? Well, they're going to pool a large number of insurees together, and taking advantage of the law of large numbers, it's going to mitigate to some degree the amount of risk that they bear. So an insurance company that's able to pool a bunch of risky policies together can manage that better than the individuals could on their own. So now let's talk a little bit about the structure of financial markets. So far what we've been talking about has been the primary market. So, for example, if I'm trying to sell shares of stock on the primary market, that means the firm is selling shares directly to investors. So it's creating new shares that are being sold directly to investors, and the money that the investors pay for these shares goes directly to the firm, which the firm can then use to fund its operations. However, when we're talking about the stock market, we're typically not talking about the primary market. Rather, what we typically think about is the secondary market, where shares that already exist are being traded between investors. So, if I go to buy a share of stock on, say, the New York Stock Exchange, that money is not going directly to the company. The money is going to the investor who held the share before. So there's no direct benefit to the company if I'm buying a share of their stock on the secondary market. Of course, companies still care about what happens to their stock, because if their stock is appreciating in value on the secondary market, that's a sign of strength for the company. It signals that they're doing well, and it makes it easier for them to raise more capital in the future. So now we want to think about a couple of different types of financial markets. So the distinction we want to make is between order-driven markets and quote-driven markets. So in an order-driven market, think about something like a stock exchange. So you have buyers and sellers that congregate at this exchange and are placing orders. And what the exchange is trying to do is trying to match buy and sell orders with each other. If I have a buy order and a sell order, and I can find a price that's agreeable to both, then I can match them and a transaction will take place. So when we think about an order-driven market, think about something like a stock exchange. As an alternative to order-driven markets, we have quote-driven markets. And quote-driven markets are sometimes called over-the-counter markets or dealer markets. And quote-driven markets are less regulated than order-driven markets, and you see a greater variety of products being sold over the counter. In a quote-driven market, rather than trying to match traders with each other, what we have are these entities called dealers or market makers that will transact directly with traders. So rather than going to an exchange and placing an order and hoping that that order is going to be matched with another trader, I can simply go to a dealer who's going to offer to buy from me or sell to me directly. Now, regardless of the structure of the financial market, they all fundamentally serve the same role, which is that we want to aggregate all the available information to arrive at the correct price. How do we do this? Well, you can think about this idea that whenever people participate in financial markets, every time you submit an order, every time you try to carry out a transaction, what you're doing is you're expressing a belief. Whatever beliefs you have about the direction that you think this asset is going, your actions about buying and selling are going to reflect that belief. And by carrying out transactions, that's going to communicate this information to the rest of the market. And so the purpose of financial markets is to collect all these different traders and all the information that they have. And hopefully by allowing them to trade, we arrive at the correct price. We get to a point where each asset is valued properly. Now, we'll spend some time in this class talking about what exactly it means for an asset to be priced correctly. So, let's start from the very basics when it comes to asset pricing, and we want to start with this concept called the time value of money. And the time value of money is a very simple principle that says that money today is worth more than the same amount of money in the future. And the reason for this is very simple. If I had $100 today, I could turn $100 today into $100 tomorrow just by doing nothing. I probably don't want to do that exactly, but I can do it if I want to. However, doing the reverse is not possible. I can't move money backwards across time like that. So there are certain things which, if I had money today, I could do that I could not do if I had to wait until the future to receive the payoff. And so therefore, getting money sooner, getting a payoff sooner is always better. So we can measure the time value of money by the interest rate. So let's say, okay, well, $100 today is worth more than $100 a year from now. How much more? Well, what I could do with $100 today is I could put it in the bank and I could earn some interest. Let's say the interest rate was 5%. That means that in 1 year, this $100 is going to become $105. Or I could take the $100 and I could leave it in the bank for 2 years. So I would earn 5% the first year, and then I would earn another 5% the second year. And so if I do that, not only am I earning 5% twice on the initial $100, I'm also earning interest on the interest that I earned in the first year. Which means that my cumulative return is going to be higher than just doubling the interest rate, right? I'm going to end up with 110.25, which is more than a 10% return. So this is compound interest, because as I earn interest on interest, the value of my deposit is going to grow exponentially rather than linearly. So if I deposit X in the bank, and R is the interest rate, and T is the number of years that I leave the money in the bank, this is going to be how much I will have after T years. So we assume that interest was paid annually, but there's no reason why it must be paid annually. It can be paid more frequently or less frequently if we want. So let's imagine we had an interest rate of 5%, but rather than being paid annually, it was paid quarterly. So there were 4 compounding periods per year. So what this means is that rather than getting 5% interest once, you're getting 1.25% interest every 3 months. Well, what you can see here is that because I am getting paid interest 4 times per year, I have more opportunities to earn interest on interest. So if I started with $100 and I'm getting 5% compounded quarterly, my effective annual interest rate is actually going to be about 5.09%, right? So you can see that if I have interest that's being compounded more frequently, I have more opportunities to earn interest on interest, and so my effective annual rate is going to be higher. Now, if I look at this expression and I think about, well, what's going to happen to the interest rate as I take the number of compounding periods to infinity? So rather than interest being compounded a discrete number of times per year, let's imagine that the value of my deposit simply grows at a continuous rate. So the number of compounding periods goes to infinity. And if you remember the definition of E, if I take the limit of this expression as n goes to infinity, this becomes x times e to the r. So if r is 0.05, this is approximately 105.1271. So as I take the number of compounding periods to infinity, I have a continuously compounded interest, which grows exponentially. And just to demonstrate to you the importance of finance in the development of math and science, this constant E was discovered as a result of people trying to derive this expression for continuously compounded interest. Okay, so we know that we can turn money today into more money in the future, right? So if I start with X, I can leave it in the bank and I'm going to earn interest of R on it. So I can turn less money today into more money in the future. Let's think about doing that operation in reverse. I want to think about, well, if I have $100 coming to me in 1 year, how much is that worth in terms of money today? Well, what could I do in order to turn money in the future into money today? I know I can't just turn $100 in 1 year into $100 today. Well, what I can do is borrow against that future payoff. So I can borrow some amount that I have to repay with interest, and I'm going to use the future payoff of $100 to repay this loan. So how much could I borrow such that $100 in 1 year would be enough to repay that loan? Well, I want X with interest to have a future value of 100, which means that X is going to equal 100 divided by 1 plus the interest rate. So if the interest rate is 0.05, this is going to be about 95. So we can say that this is the present value of this future cash flow. $100 in 1 year can become 95.238 today because we can borrow against this future cash flow and turn that into a present cash flow of 95.238. And therefore, if I want to compare the future payoff to something in the present, I can assign it a present value equal to this much. Another way to say this is that future payoffs are going to be discounted by a factor of 1 over 1 plus r. So the discount factor is going to be about 0.95238. So this means that payoffs that come in the future are not worth as much as payoffs today. So in general, if I have a payoff CT that comes in year T, so T years from now, then I need to discount it by 1 over 1 plus R to the T. So the present value of a future payoff that comes in year T is CT divided by 1 plus R to the T, because if I were to put this much in the bank, I earn T years worth of interest, I would end up with exactly CT. The nice thing about present values is that they're additive. So let's imagine I had a sequence of cash flow. So I got C1 in year 1, C2 in year 2, C3 in year 3. The present value of this entire stream of cash flows is just going to be equal to the sum of the present values of the individual cash flows. Sometimes we also want to be talking about net present value. So whenever we're talking about investment projects, typically we think of a project that's going to require some initial investment, C naught, which is going to be negative, and then we're going to get positive payoffs in the future. And then we want to evaluate the entire project and see, well, if I sum up the present values of all of these cash flows, am I ahead or behind? So the net present value is just going to be the present value of future payoffs plus whatever payoff I have today, which can be positive or negative, but implicitly we tend to think about the initial investment as being negative and the future payoffs as positive. So we talked about how net present value is something that we can use to assess whether a particular investment project is worthwhile. So net present value, however, is not the most intuitive way to think about it. Typically, when people think about whether an investment opportunity is worthwhile, they measure the rate of return. So let's imagine that you have an investment. You have to pay $300 today, and you get $325 1 year from now. So if you look at something like this, it's very easy to compute the rate of return. The rate of return is going to be 325 minus 300 over 300, or about 8.3%. So if the interest rate is 5%, then this project looks like a good idea because we're getting a higher return from doing the project than we would if we had just put the money in the bank. And indeed, if we calculate the net present value, minus 300 plus 325 over 1.05, that's going to give us a positive NPV. So this project generates additional value. I'm better off investing in this project rather than just putting the $300 in the bank. But if the interest rate were instead 10%, the net present value of this project is going to be negative. And that's because since I'm only getting an 8.3% return by investing in this project, I'm better off just putting the $300 in the bank instead. I would get more out of it that way. So the rule we can use is that we want to invest in a project as long as the NPV is positive. Now, using this rule is similar to saying I want to invest in a project if the return is higher than the interest rate. Now, the reason the NPV rule is useful is that for a simple project like the one we just introduced, it's easy to calculate the rate of return because I have a one-time cost and a one-time payoff. But if I have a more complex project, it can be harder to define what the rate of return is, but as long as we know the interest rate, we can always calculate the net present value. So the NPV rule is typically a little bit more handy than trying to think about the rate of return on a project, even if it's slightly less intuitive. So let's let R be 10%. And let's imagine I have a project where I build a factory that's going to cost me $500 today, and then I get paid $200 for each of the next 3 years. So in this case, the rate of return is not that easy to define. I could think about, well, I get a total payoff of $600, so that means that out of an initial investment of $500, that represents a 20% return. But that's not quite correct because this stream of cash flows is not the same as getting paid $600 in a lump sum at a certain point in time, right? So what I need to do is that I need to compute the net present value discounting each of these cash flows properly. So 200 comes in year 1. I'm discounting that by 1.1. Another 200 comes in year 2. So I discount that by 1.1 squared. And then another 200 comes in year 3. I discount that by 1.1 cubed. I solve all of that, and I get that the NPV is about minus 2.63, which, being negative, means that this project is not worth investing in. What this is saying is that I am better off putting $500 in the bank and earning a 10% interest rate rather than investing in this project. Well, you might be saying, well, what if I preferred to get these periodic payments? instead of just putting $500 in the bank and waiting for it to appreciate, I wanted to get regular payments for the next 3 years. Well, what we can show is that if you had $500, you could replicate these payments by just putting $500 in the bank. So let's think about how you can do this. So the payoff in year 1 is $200, and the discount factor is 1 over 1.1, or about 0.909. This means that in order to get a payoff of $200 in 1 year, you would have to deposit about 181.8 and withdraw it after 1 year. The payoff in year 2 is also 200, and the discount factor for this is 1 over 1.1 squared, which gives you a discount factor of about 0.826. This means if you wanted to replicate this payoff, you would have to put about $169 in the bank and withdraw it after 2 years. And then finally, for the third payment, the discount factor is about 0.751. And so to replicate this payoff, you would have to put $150 in the bank and withdraw it after 3 years. So if I were to make all 3 of these deposits, then I would be able to withdraw 200 after 1 year, another 200 after 2 years, and another 200 after 3 years. And if we sum all of these up, we get that this is only going to require about 497, which means that if I had $500, I could make all 3 of these deposits, withdraw 200 after each of the next 3 years, and then I would still have about another 263 left over. So I can do better than investing in the project. That's what it means to have a negative NPV, that I have an alternative where I can get the same payoffs but still have some more money left over. And that's why this project is not worth investing in. Now that we know a little bit about interest rates and discount factors, we want to talk about assets and trying to price them. And we're going to start with kind of a peculiar example. We're going to start talking about perpetuities and annuities. So, to give you the right frame of reference for perpetuities, I'm sure many of you have read the Jane Austen novel Pride and Prejudice, where there is this guy called Mr. Bingley who is notable because he has an income of £4,000 to £5,000 per year, which at the time that the book was written was quite a lot of money. And so, of course, this made him a very eligible bachelor, and all the young women in the town wanted to marry him. So, what does it mean for him to have $4,000 to $5,000 a year? This is not how we would express someone's wealth today, right? If we're talking about someone being wealthy today, we would say, well, oh, this person has a net worth of however many $1 million, right? We wouldn't try to express their wealth in terms of an annual income. And don't get this mistaken. This income does not reflect his salary. He's not a working class person that's earning money for his work. This is all passive income from his investments. So what type of investment are we talking about? Well, we're talking about a type of security called a consul, which was issued by the British government in the 19th century, and the consul was a type of perpetual bond. You would invest in consuls, and you would continue to earn interest forever, which means that the principal would never be paid back to you. Instead, you would just keep earning interest forever, and this would guarantee you, at least on paper, an income in perpetuity. So what this income of £4,000 to £5,000 per year represents is that Mr. Bingley has a net worth of £100,000, and the interest rate fluctuates between 4 to 5%, and so the interest that he can earn on his wealth of £100,000 is going to be between 4 to 5,000 per year. That's what they're talking about. So a console seems a little bit odd, right? Typically we think about bonds as having some maturity date where you're being paid back in full. With a perpetuity, you're continuing to receive cash flows forever. Now, while this might seem odd, this actually makes perpetuities quite easy to price. So let's imagine I have a sequence of cash flows where I get the same payoff every year forever. So what's the present value of this perpetuity? Well, I have c divided by 1 plus r, plus c divided by 1 plus r squared, plus c divided by 1 plus r cubed, and so on. So I'm going to have an infinite series going from t equals 1 to infinity of c over 1 plus r to the t. Now, the nice thing about series like this is that they converge. So what I can do is I can pull out c over 1 plus r, and I'm going to have the sum from t equals 0 to infinity of 1 over 1 plus r to the t. So I have this power series here. And with this power series, I have a formula that I can use to calculate what this is going to be. So let's imagine I had a geometric series that was 1 plus a squared plus a cubed, or the sum from t equals 0 to infinity of a to the t. Now let's call this thing big A. Well, if I were to multiply big A by little a, I would get a plus a squared plus a cubed, and so on. If I were to subtract 1 from big A, I would get a plus a squared plus a cubed, and so on. So I have little a times big A is equal to big A minus 1. Rearrange this thing, what do I get? I get big A is equal to 1 over 1 minus little a. Now the important thing to realize is that this formula is only going to work if little a is less than 1. If little a is bigger than 1, then each term is bigger than the last one, which means that the series won't converge. So if the series does converge, then it's going to have a value 1 over 1 minus a. Now, for a perpetuity, we had c over 1 plus r times t equals 0 to infinity of 1 over 1 plus r to the t. So here, a is 1 over 1 plus r. So I have c over 1 plus r times 1 over 1 minus 1 over 1 plus r. I can simplify this a little bit. I turn this 1 into 1 plus r over 1 plus r, and then I cancel out here with this. This cancels out with this 1. So what do I get? I get that the present value of a perpetuity is just equal to its annual cash flow divided by the interest rate. So, for example, if I'm Mr. Bingley, I'm getting paid £5,000 a year, and the interest rate is 5%, well then the present value is going to be 5,000 over 5%, which is going to give me £100,000. So if you're thinking that perpetuities are a pretty sweet deal and you're kind of sad that you can't buy them anymore, well, never fear. There is a way you can replicate a perpetuity just by putting money in the bank. So how would you do that? Well, let's say I deposit $100 in the bank today. Then after a year, I'm going to have 105. If the interest rate is 5%, I'm going to earn $5 worth of interest. And then what I'm going to do is I'm just going to withdraw just the $5 in interest, and I'm going to end up with $100 at the end of year 1, which means at the beginning of year 2, I'm going to have 105 again, and then I withdraw $5 at the end of year 2, and so on. So what I'm doing is I'm depositing money in the bank and never withdrawing the principal. I'm only withdrawing the interest every year, and in so doing, I can exactly replicate the sequence of payoffs that I would get from investing in a perpetuity. So what you can see in this table is that every year I'm earning $5 of interest, and then I'm withdrawing $5, which leaves me with an ending balance of $100. So everything stays constant over time. So this is going to be in contrast with some of the examples we're going to see in a little bit. So, one thing you might be thinking when you're thinking about perpetuity is, well, if I had an investment that guaranteed me a fixed payoff every year, well, that sounds like a good idea, but it fails to take into account inflation, right? If Mr. Bingley had invested his £100,000, which was a lot of money in his time, and that was guaranteeing him £4,000 to £5,000 a year, well, yes, in his day, that was a very high income. But nowadays, well, that's not nothing. That's not really a very large amount of money anymore. So rather than investing in a perpetuity that's going to promise me the same payoff every year forever, well, what I really want is something that's going to grow, that's going to at least keep up with inflation, so that I can maintain the same kind of purchasing power, the same kind of standard of living in perpetuity. So instead of having payoffs that are the same every year, what I want is I want my payoffs to grow. So I'm going to start at C, but in year 2, I'm going to get C times 1 plus G. So G is going to be my growth rate. And then year 3, I'm going to have C times 1 plus G squared. Year 4, I'm going to have C times 1 plus G cubed, and so on. So rather than having a constant payoff every year, my payoff is going to grow every year, hopefully to continue a certain level of purchasing power and a certain standard of living. If I want to write out the present value, instead of just having the denominator be multiplied by 1 plus r every term, I'm going to multiply the denominator by 1 plus r, but I'm also going to multiply the numerator by 1 plus g. So the discount factor is growing, but so is the payoff that I'm discounting. So this is going to be the sum from t equals 1 to infinity of c times 1 plus g to the t minus 1 over 1 plus r to the t. So what you can see here is that the term in the denominator is always 1 power higher than the term in the numerator. Well, we want to fix that if we want to use our geometric series formula. So just like before, we're going to pull out c divided by 1 plus r, and then in the summation, we're going to be left with 1 plus g over 1 plus r to the t from t equals 0 to infinity. So we're going to apply the geometric series formula to this term. So we're going to have c over 1 plus r times 1 over 1 minus a. In this case, a is 1 plus g over 1 plus r. We're going to do the same thing as before. this 1 plus r is going to become 1 plus r over 1 plus r. Cancel here. The 1 cancels, and we're going to end up with c over r minus g. So the present value of a stream of cash flows that grows at a constant rate of g forever is going to be c, which is the first payment that I get, divided by the interest rate minus the growth rate. So let's think about an example of what we could do here. Let's say the interest rate is 5%, and I want my payoffs to grow at 3% a year. That means that if I were to deposit $100, so I have a present value of 100, that means I could have payoffs starting at $2 and then growing at 3% from there. Okay, so let's contrast this with the example we had with the non-growing perpetuity. With a 5% interest rate, I have a couple things I can do. I can deposit $100 and then withdraw $5 every year. That's good at the beginning, but as time goes on, that $5 is going to become worthless. Or what I could do is set it up so that I deposit $100 today, and then I'm going to earn $5 worth of interest again. But rather than withdrawing all of the interest I've accumulated, I'm only going to withdraw a proportion. I'm only going to withdraw $2, and I'm going to be left with a balance of 103, which means that in year 2, I'm going to earn a little bit more interest on this, right? And that's going to allow me to withdraw more and more. So let's look at the table. In year 1, I earned $5 worth of interest. I withdraw $2, and I'm left with a balance of 103. In year 2, because I have 103 now, I'm earning 5.15 in interest. And so I'm going to withdraw the same proportion of this. So with $5, I withdrew $2. I'm going to withdraw 2.06 here. And I'm going to end up with a balance of 106.09. So in year 3, that means the amount of interest that I earn is going to grow, and the amount that I can withdraw is going to grow, and my ending balance is also going to grow. What you can see here is that for all 3 of these columns, they're all going to grow at the same rate of 3%. So my balance is growing by 3%, the amount of interest I earn on that balance is growing by 3%, and therefore the amount that I withdraw is also growing by 3%. These numbers are going to start off smaller, right? If I compare this to the non-growing perpetuity, the non-growing perpetuity allow me to withdraw $5 a year right away. So these numbers start off smaller, but over time, of course, if you think about this column is growing at 3% a year, eventually it's going to overtake the constant payoff of $5. So you can think about with a growing perpetuity, it's the same as putting money in the bank, but only withdrawing a portion of the interest, which allows your balance to grow, which in turn allows the amount that you can withdraw to grow. The important thing with growing perpetuities is that this only works if R is greater than G. You cannot have a growing perpetuity where the growth rate is higher than the interest rate. And you can see this because if the growth rate is higher than the interest rate, then each term is going to have a higher present value than the last term, which means I'm going to have a sequence of ever increasing terms, and that's not going to converge. So in order for a growing perpetuity to converge, the interest rate has to be higher than the growth rate. I can't set it up in a way where the rate at which my payoffs are growing is faster than the interest rate that I'm using to discount those payoffs. So perpetuities are an interesting concept and an interesting kind of historical anomaly, but of course they're not really that widely traded anymore. Part of the reason is just because it's weird to think about some type of financial security that's going to continue paying forever. I mean, what does that even mean? Can you trust that any entity that you lend to is going to be around forever? So something a little bit more plausible and something that is a lot more widely seen these days are annuities. And so an annuity is like a perpetuity, except it terminates at some point in time. So the payoffs stop at some maturity date, which we're going to usually label as big T. So if you think about a typical loan, you're paying off not just interest, but you're paying off the principal so that by the end of the loan, you've paid off the entire principal with interest. Another place that you've seen annuities probably is with lottery payouts. If you drive on the highway and you see, a Powerball billboard that's advertising a $500 million jackpot or something like that, well, those jackpots don't actually reflect how much money you would get paid if you won, because those jackpots reflect the annuity payout. So you would be getting paid that $500 million, for example, over the next 25 years. You wouldn't get it all at once. Another place that you'll see annuities is with sports contracts. Probably the most infamous example is Bobby Bonilla, where the Mets agreed to defer his salary from 2000 into an annuity that paid over 25 years, so that Bobby Bonilla is going to continue getting paid by the Mets all the way up until 2035, even though he hasn't played for them since the year 2000. So if we're writing the present value of an annuity, we're going to start with the same expression as with the perpetuity, except instead of taking this series to infinity, we're going to end it at year big T. So instead of having an infinite series, we just have a finite series that goes from t equals 1 to t equals big T. Which means that the present value of an annuity doesn't just depend on the cash flow and the interest rate, it also depends on this maturity date, how long the annuity goes on for. So if we're thinking about how to come up with a pricing formula for annuities, we are going to establish a principle that we're going to come back to over and over again throughout this course, which is the idea of a replicating portfolio. So if I think about year 1, 2, all the way to t, t plus 1, t plus 2, and so on, an annuity is going to keep paying me until year t, and then it's going to stop. So I am going to replicate an annuity using perpetuities. I know what the price of a perpetuity is, and if I can construct a portfolio that gives me the same payoffs as the annuity using perpetuities, then the price of that portfolio should be the same as the price of the annuity. So we're going to start with a perpetuity that starts in year 1. This is just going to keep paying me, not just through period t, but forever. But then I'm going to think about a perpetuity that doesn't start until year t plus 1. So I have perpetuity 1 that starts in year 1, perpetuity t plus 1 that starts in year t plus 1. And so what you can see right away is that the annuity is the difference between perpetuity 1 and perpetuity t plus 1. So let's think about a portfolio where I buy this perpetuity and then I sell this one. So for the first t years, I'm getting paid C. And then after year t, well, because I bought perpetuity 1 and sold perpetuity t plus 1, these payoffs are going to cancel out and I'm going to end up with 0, just like with the annuity. So if I know the price of perpetuity 1, I know the price of perpetuity t plus 1, I'm going to know the price of the annuity. So perpetuity 1, we know what the price of that is. It's just a regular perpetuity, it's C over R. Perpetuity t plus 1 is a little bit more complicated because it's the same as perpetuity 1, but just delayed by t periods. So it's going to be C over R, but then we're going to discount it by an additional t periods because it's being delayed for that long. So the present value of the annuity is equal to the present value of perpetuity 1 minus the present value of perpetuity t plus 1. Why? Because a portfolio where I buy this and sell this will give me the same payoffs as the annuity, and therefore it should have the same price as the annuity. And so I'm going to get that the price of the annuity is C over R times 1 minus 1 over 1 plus R to the t. So this is the annuity pricing formula. You can see that the longer the annuity goes on for, the smaller that this term is, which means as t goes to infinity, this is going to converge to the perpetuity formula. So let's take a look at an example that you might see with an annuity. Let's imagine that we have a mortgage loan. So I have a 15-year mortgage, and I have an interest rate of 6%. And here I'm going to say that the present value is 1 million. So I'm taking out a 15-year mortgage to buy a house that's worth $1 million. So what I want to do is, I know the present value, I'm going to use the perpetuity formula to figure out my payments. And just to add another wrinkle onto it, I'm going to assume the payments are made monthly. So I have 12 compounding periods per year. All right, so let's think about how we would use the perpetuity formula. The perpetuity formula was C over R times 1 minus 1 over 1 plus R to the t. So what changes when we go from annual payments to monthly? Well, rather than having 15 payments at an interest rate of 6%, I'm going to have 180 monthly payments at a monthly interest rate of 0.5%. So I'm going to write R over N here and here, and I'm going to write NT here. That's going to be C over 0.005 times 1 minus 1 over 1.005 to the 180. And so what I'm going to do is I'm going to set this whole thing equal to 1 million. And so I'm just going to divide through by this factor. And if I divide through by this factor, I can solve for C. My monthly payment is going to be 8,438.57. So this is how much I would have to pay back every month in order to pay back a $1 million loan over 15 years. What you can see in this table is that with an annuity, the loan is accumulating interest every year, but what you can see is that the monthly payment exceeds the amount of interest, which means of that $8,438, in the first year, $5,000 of it is going to pay interest, but then the remainder is going to pay back some of the principal. And what this means is that the loan balance is decreasing over time. So the payment stays constant, but the loan is gradually being paid off over time, which means over time, more and more of those payments are going toward paying back the principal of the loan rather than interest, so that by month 180, the loan has been entirely paid off. Okay, so we talked about perpetuities, we talked about growing perpetuities, we talked about annuities. Well, there's only one more thing to talk about, which is growing annuities. So with the growing annuity, that just combines the features that we've been talking about, where the payoff grows every year, but it's also going to terminate at some period t. So it's not going to go on forever. So it's going to be a growing sequence, but it's going to be finite. So just like with the regular annuity, we're going to think about how we can replicate that with perpetuities. So with the annuity, we start at C, it's growing every year, and it ends in period T. With perpetuity 1, it's growing forever. And with perpetuity T plus 1, well, I'm delaying it by T periods, but because I'm delaying it by T periods, I also need to start it off at a bigger value. So once again, I have two perpetuities. One perpetuity that starts immediately, one that starts after T years, and the difference between these two perpetuities is going to give me the same payoffs as the annuity, and therefore the difference between the price of perpetuity 1 and the perpetuity T plus 1 will give me the price of the annuity. So for perpetuity 1, it's going to have a price given by the growing perpetuity formula. For perpetuity T plus 1, it's going to be, once again, discounted by an additional T periods. But if you remember, because it's being delayed, it also has to start off at a higher value. So the starting payoff is also going to be higher by a factor of 1 plus G to the T, which means that the present value of the annuity is going to be C over R minus G times 1 minus 1 plus G over 1 plus R to the T. So this is the formula for a growing annuity. So let's use the lottery as an example. Let's imagine that you just won the lottery and you have two options. You can either get a lump sum of 100 million, or you could get a 25-year annuity that grows at 4% a year, starting at 5 million. So if I were to drive by the billboard, this would be advertised as 5 million times 1.04 to the T minus 1. So the billboard would advertise the value of the jackpot ignoring the time value. So the nominal value of all the payments I would receive with this annuity would be about 208 million. So I can either get $100 million right away, or I could get an annuity with a total value of 208 million. Of course, as we've seen, this number doesn't matter because it ignores the time value of money. We need to discount these payoffs properly. And let's say that we want to use an interest rate of 6%. If the interest rate is 6%, which of these looks like a better idea? Well, let's use the growing annuity formula. So the present value is going to be 5 million divided by R minus G. So 6% minus 4% times 1 minus 1.04 divided by 1.06 to the 25. If I plug in all these numbers, I get that the present value of the annuity is about 94.7 million, which is less than the 100 million lump sum. So I'm better off taking the lump sum. Now you might say, well, maybe it's better to get the annuity because if you get the $100 million now, you would just spend it right away, whereas getting the annuity would ensure you would have a steady income over the next 25 years. Well, if you wanted a steady income over the next 25 years, what you could do is take the lump sum of $100 million. You have an interest rate of 6%, so you could earn 6% interest every year. You could replicate this annuity. So you take 94.7 million and replicate this annuity, and then the remaining 5.3 million you would have available to spend today. So even if you wanted to be paid out over the next 25 years, you're still better off taking the lump sum. So if you just look at the table for the growing annuity, what you can see is that this sort of combines the features of the tables we've seen before, right? Initially, we're withdrawing less than the amount of interest, which allows the balance to grow, just like we would see with a growing perpetuity. However, over time, the amount that we're taking out starts to exceed the amount of interest, and by the end of the annuity, the entire balance has been exhausted and we've withdrawn everything. So that's the table for a growing annuity.